Good evening, everyone. My name is Howard Brady. I'm a Senior Vice President, Chief Lending Officer here at American Eagle Financial Credit Union. So thank you very much for agreeing to be here. We're very pleased and excited to be able to deliver this content to you tonight. It's a topic that we're very, very passionate about. And very simply, we're going to help you understand your credit tonight. We're going to help you protect your credit, ultimately, and also want to help you understand how to improve your credit. I want to talk a little bit about our mission. That's something that we're very passionate about as a credit union, and it's pretty straightforward. We are a progressive financial institution providing competitive products and services and an outstanding consultative service experience that surpasses member expectations. And very simply, we're going to raise the curtain on the credit model tonight to really demystify it. Unfortunately, there's a lot of confusion surrounding the credit model and how credit scores are composed and how they are calculated. And I'm confident that once we conclude the call, you have some very actionable ways to take a look at your credit report, understand what's happening within that report, and ultimately how to improve some of those things in your bureau, or conversely, protect the quality credit score that you currently have. So that being said, certainly want to empower you in your financial life to not just be successful today, but also in the future. And that's really how borrowing needs are handled. You're going to have an emerging set of needs over the course of your life, and we want to be an institution that ultimately can illustrate for you how to pay your creditors less. And we think that that's a unique approach here at the credit union. And very simply, we think that we have a competitive advantage in terms of the credit union difference. We have members, not customers. We're local and we're organized to serve the interests of our membership. We have a community-based charter. We serve 4 counties. We serve Hartford, Tolland, Middlesex, and New Haven. We just got a brand new state charter at the end of last year to be able to serve New Haven County. We're very, very pleased and excited about that. Credit unions really provide a variety of values across the board. We very simply are a not-for-profit. We're in a very unique position to be able to put the members at the center of every financial transaction. And the content tonight is really no different than that. We want to ultimately enable you to understand how to pay your creditors less. And ultimately, we believe that will continue to engage our membership and also allow us to continue that loyalty and build that trust as a financial advisor for you. I think it's fair to say that credit unions are not focused on profits. We're focused on helping folks, and we take a lot of pride in that. Any money that we do make, and we certainly need to keep the lights on, I think that's a fair statement, we reinvest back into the business. So ultimately for credit unions, it's not about money. It's about the people, and that's really ultimately what it's all about for us. We have a volunteer board of directors. There are no golden parachutes here, and there are no IPOs. We're not publicly traded. But we are regulated by the state of Connecticut as well as the NCUA, so we have deposit insurance for any deposits that we have here at the credit union. We can serve anyone who lives, works, worships, attends school in, does business in Hartford, Middlesex, New Haven, or Tolland County. Very simply, all it takes is a $5 minimum deposit for a savings account for you to be eligible for all the products and services that we provide. Ultimately, immediate family members are also eligible, which is a nice piece, even if they don't live in our community footprint. So if you have a brother, if you have a child, if your parents want to join the credit union, we are certainly ready, willing, and able to serve them if you're already a member. So understand that, and we'd love to continue to try to not only serve you, but continue to grow membership and folks in your household. All right, so let's get to the agenda. In simple terms, we want to talk about understanding, improving, and protecting your credit score. We're going to cover a couple different pieces of that. We're going to go over the company that is the purveyor of the model, the Fair Isaacs Company. They developed the calculation and the methodology to determine FICO scores. We're going to do a credit report overview of some of the things that are embedded in your credit report that you need to be aware of. We're going to do a pricing matrix review. And that is something that every lender has. I want to give you a sense of how interest rates are determined, because a big part of what we're talking about here today, folks, is the interest that you're ultimately going to pay related to your credit score. And again, we wanted to try to make it as simple as we could, and we want to illustrate to you how to pay your creditors less, and that includes us. We believe that's part of our mission. We're going to talk about how to establish credit. We've got some good strategies for you to get a score. as well as 5 characteristics of your FICO score. This is where some of the magic's going to happen, folks. And that's going to be about 15, 20 minutes of the presentation, and we're really going to dig down on a granular level so that you can see how some of the model works and calculates a score. But also at the very end, I'm going to bring it back up to a global level and give you some very insightful and actionable takeaways that you can apply in your day-to-day, week-to-week, month-to-month lives in relation to your credit score. Finally, I'm going to show you how to improve your score, and I think that everyone is probably interested in that. I just want to give you a little disclaimer. There are a variety of credit models out there, even within the context of the Fair-Isaacs Company, which is the purveyor of the FICO model that designed the way that this score will be calculated. And even within that, there are product-specific scores. So what you see in front of you right now, you'll see several red circles. Those are credit models that calculate scores just a little bit differently than the other ones. And that's important to understand because what we're going to talk about tonight are general principles that we can apply and understand that each credit model can be a little bit different and look at things a little differently, but certainly every individual scenario is unique, and certainly that can have an impact on how the credit model is going to view the score. So what is a credit report? Very simply, your credit reports are a financial report card with information about your payment history and account information. Ultimately, your credit report is going to determine how much you'll pay to borrow, but it's really much, much more than that. And we're going to get into that in a little bit more detail in a few minutes. But I think the main focus in terms of credit score is how's it going to determine my interest rate. So let's talk a little bit about what a FICO score is, what a credit score is. It's basically a 3-digit number that reflects the likelihood that you'll repay your bills on time. So lenders use this score to assess risk from a pricing standpoint. And that's a very important distinction because it's not underwriting, and we're going to get into some of that dialogue here tonight. The Fair-Isaacs Company, FICO, was founded in 1956 as Fair-Isaac & Company by engineer William Fair and mathematician Earl Isaac. It is one component of your credit report in terms of the FICO score. It's arguably the most important piece. Fair-Isaac's the company that established the standard formula used by the 3 major credit agencies for scoring, and we're going to get into the credit agencies here in just a second. The FICO score debuted in the late 1980s, so it's been the gold standard for a long, long time. And just understand that the score range associated with FICO is about 300 to 850. So just want to make sure that everyone's aware of that. That's the broad range of scores. So let's talk a little bit about the reporting agencies. There are some real geographic implications here that we just want to highlight for you briefly. We've got Equifax, which is predominant in the Southeast. We've got TransUnion, which has some real affinity in the Northeast. And then Experian is prominent on the West Coast. And these companies compile credit information, calculate the score using the FICO model through a monthly tape that is sent to the bureaus, the credit bureaus, every month. So every lender has activity for every individual, for every loan, based on the payment history associated with it. And those tapes will go to the credit bureaus. That information is aggregated, and that's where the calculation of the score starts to happen. All right. One thing that I do want to highlight, if you were to walk into the credit union today and apply for a loan, if it's not a mortgage, if it's a consumer loan, whether it be an auto or a credit card or something like that, we're going to pull your TransUnion score. It's a single score. Conversely, if you apply for a mortgage here at the credit union, we're going to do what's called a tri-merge. That's a score from each one of the bureaus that we just talked about, Equifax, TransUnion, as well as Experian. And that really is intended to really give a deeper look. Typically mortgages are going to be a bigger ticket item, and get a deeper look into assessing the risk associated with lending those larger dollar amounts. So let's get into a little bit some of the components of the report, what we call FICO Facts. The reports have your personal information and public records. We're going to define public records here in just a minute. It's got the type of trade line that you might have, whether it be a mortgage, an automobile, a credit card, and we can also include lines of credit there as well. It's got the open date of your trade line when you took out the loan, the date of last activity from the lender. Terms and monthly payments are also included. It'll have the original amount, it'll have the payment, and also the duration of the obligation. So let's say I had a car loan and it started at $20,000. The term was 60 months and the payment was $300. It has all three of those factors. Credit reports do not include the interest rate that you pay on your debt. You can figure it out, however, on installment loans because it's basic algebra. If you have three of the factors, you can solve for the fourth. And that is something that we take a lot of pride in here at the credit union, just to highlight that. But that is the way that the terms and monthly payments come together on your bureau. Credit limit and original amount of what you borrow is certainly included. The recent balance and the high balance is also present. That's especially useful for credit cards. The status and account history is all there. There will be a 2-year window of month-to-month payment history that we can take a look at to kind of see trends and understand what's going on. And then on a more global basis, it's got a 4-year window that we look at that's not quite as granular, but it'll tell us how often you were late. Last but not least, we've got inquiries. Inquiries happen anytime you get your credit pulled. We're going to go into that scenario in depth tonight and really shed some light on that for you. Last but not least, in terms of FICO Facts, just want to make sure that everyone understands that your score is really just a snapshot in time that can change daily depending on activity and when the tapes are sent to the credit bureaus. So the concept to be aware of right there is that your credit score is dynamic. It's always evolving and changing. Okay? Just want to make sure that we're on the same page in that regard. So let's shift gears a little bit and talk about FICO fallacies. We've talked about FICO Facts. Let's go a little bit into some of the misperceptions about the FICO score. A score determines whether or not you can get credit. That's simply not true. That's basically an underwriting decision. The score is used to price a loan. And what we get into when we start talking about will we or will we not do a loan, we're talking about qualifications. We're talking about income, assets, employment, residence. If it's an auto loan or a mortgage, down payment, things of that nature that are more relevant in that regard than the score. The score is going to tell us how to price the loan. Another misperception is that a poor score will haunt you forever. That's not true either. And that's really part of the reason we wanted to do this webinar for you tonight, to illustrate how easy some of this can be in terms of deepening our understanding related to the credit model. I will say this. Let's say you've got challenged credit and things are problematic for you, finding ways to get your financial needs met in terms of lending. If you've got an account here and you've paid us here, we pride ourselves on being a relationship lender. Every family has a hierarchy of how they get paid, of how they pay their bills. And ultimately, the thing that I wanted to convey to you tonight would be always have the credit union at the top of your list. Hopefully it's American Eagle, but if it's another credit union, that's okay too. But in any event, you always want to make sure that you have the credit union at the top of the list. Ultimately, we're going to have a better chance to help you, maybe than some others on the financial services landscape, and that we'll always be here for you. So I just wanted to make sure that we were clear about that. Last but not least, credit reports include information on income or your savings. That's a fallacy. That is not true and has no bearing on your credit score. So we've talked a little bit about risk-based loan pricing and how loans get priced. Basically, borrowers who get the lowest interest rates are those with the higher credit scores and solid credit history. Conversely, if you've got challenged credit, typically the terms will not be quite as agreeable or as aggressive or beneficial to you. So really, the purpose behind this webinar is to try to show you how easy that can be. So let's talk about the score range. Here's an example of a pricing matrix, and every lender has one. So here's an example where we've got Platinum, which is the best of the best in terms of credit, starts at 759. We've got A paper from 720 to 759. We've got B paper, 680 to 719. C paper, 640 to 679. D paper, 600 to 639, and E paper is less than 600. As we move down the matrix, as we get into the D and E paper, those scores are indicative of a couple different things that we're going to talk about. Challenges with late payments, collections, public records, things of that nature. So just want to highlight, as we move down the credit spectrum, those are going to be some of the potential things that can drop your score in a significant fashion. So let's just take a look at the total cost of a loan. And we've got an A paper member and a C paper member. So what we've got here is a $15,000 car loan, 60-month term, new vehicle. The annual percentage rate associated with an A paper member is 1.79. That's a very aggressive rate. It's actually indicative of a promotion that we have running here at the credit union through November the 7th. And that's an unparalleled rate. And we've seen a lot of activity here at the credit union as a result of that. But you'll see the corresponding payment, some really good things start to happen with that type of a rate. We've got a monthly payment of $261.54. Over the course of the loan, if the loan goes 60 months, the finance charge is going to be $692.41. So if this loan goes 60 months, the total payback is $15,692.40. Conversely, we've got a grade of paper of C on the other side of the ledger. We've still got an aggressive interest rate, but it's certainly not 1.79, but it's still very good. Monthly payment of $284.24, finance charges of $2,054.30, resulting in a payback of $17,054.40. The differential there being $1,362. So just want to kind of highlight from a financial standpoint what the impact is on a car loan, and I'm pretty confident everyone on the call has a car, and that you probably have a loan associated with it. This is a very real example of how to benefit today, but also understanding credit will help you be successful and set the table for future success. So let's dig a little bit into how credit reports are used. It's pretty obvious that they're used in lending decisions and pricing loans regardless of the type, whether it be a car loan, a mortgage, things of that nature. So we got granting credit at the beginning of the cycle, and we've talked a lot about determining interest rates at this point. It can certainly get into rental of apartments. You know, a credit score can have an impact on whether or not you need to give 1 or 2 months security deposit, or may preclude you altogether from getting the housing that you really desire. Certainly employers across the country are using credit scores more and more as an indicator of future success when they hire new folks for their companies. Certainly don't want your credit to preclude you from getting your dream job. Insurance, it's becoming more and more common for credit to be pulled in giving quotes for auto policies as well as homeowners policies. Professional licenses in the state of Connecticut, if you're a licensed mortgage originator, you're going to have your credit pulled. And certainly contractors are going to have a licensing equation, a licensing bond. They're going to have to get their credit pulled too. So it's becoming more and more relevant even outside of the lending landscape. And then last but not least, utilities. Oftentimes a utility company, whether it be water, sewer, power, whatever the case may be, may require a security deposit in order for you to get the services that they provide. So a lot of that is very simply backdrop. And we're going to get into the factors affecting your credit score. This is really the crux of the matter. And we're really going to shed a bright light on this tonight, and it's something that I think you'll find very useful. So let's get into it a little bit. 35% of your score revolves around how you pay your bills, not surprisingly. 30% of your score revolves around capacity. So if you're unfamiliar with that term, capacity in the simplest terms really is this. It's the relationship of your balances for credit cards and lines of credit in relation to your limits. All right, and we're going to dig into that one pretty extensively, because if you take a look at the addition of those two pieces, that's 65% of your score, and I think we'd all agree that that represents a pretty fair percentage. Length of your credit history is 15%. We've got new accounts and inquiries accounting for 10% of your score, and then kind of rounding out the equation, we've got the account mix at 10%. So in order to establish or reestablish credit, let's talk about this. You're going to need one trade line for 6 months with activity for each month. So that's on the establishing credit side. You can certainly get a secured credit card. That's a very good way that we help folks establish credit. You can get a co-signer for an auto loan. A little bit more difficult. You'd have to have somebody sign the paper with you, and those folks would ultimately be accountable for those payments as well. So maybe a little bit more difficult proposition. But certainly something that we've seen happen. And then authorized users. This is a strategy that can be utilized if there are, so let's say a family, father and mother want to help their 18-year-old establish credit. They can actually get a credit card for that child as an authorized user. Once that card comes in, probably cut up the card to help that child establish credit. That credit will now show up on that credit report to give that person some credit. Here's the potential rub with that. The person's credit score will rise and fall with the payments associated with that trade line. So it is something that can be done, but certainly want to be very mindful and cautious of it. I will say that the more refined that the credit models have got over time in relation to this this piece of our discussion, it's becoming a more diminished effect in terms of giving folks a lot of credibility. FICO has really kind of addressed that, but it is still a strategy that's used and can work for you. You can apply for a secured card and get two big benefits out of it. It can help you establish new credit, and I think that we touched on that a little bit. Very beneficial. It doesn't take a lot of money to be able to do that, and within 6 months you're going to have a nice solid score. Certainly can help you reestablish credit if things have gone the wrong way for you in relation to your credit score, and we understand that. Bad things happen to good people. We can certainly use a secured card to help you reestablish as well. So let's get into how the credit model works. So how you pay your bills. Here are some serious issues that can really be problematic for you over the course of about 7 years. These are issues that will be on your bureau for a long, long time, and 7 years is a good number to assign to that. So let's talk about bankruptcy, for example. There are 3 different types. We've got Chapter 7, Chapter 11, and Chapter 13, all of which will drop your score significantly immediately. Foreclosures certainly will make it more difficult for you to own a home in the short term. That can be overcome from a credit standpoint as time elapses. Auto repossessions can be a real problem for you. If you have a repossession, oftentimes the car will be sold at auction. There could be what's called a deficiency balance associated with that, where the borrower would still be liable for the amount of money that made up the difference between what the car was sold for and what the borrower ultimately was lent for the car. And that certainly can be problematic, because if you've got a previous repo, don't be surprised if somebody asks you to put some significant money down to kind of manage that risk from the lender's perspective. So a repossession is certainly something to be mindful of. Judgments are a decision giving creditors the ability to do things like garnish wages. Those are court proceedings. Judgments allow things like that to happen, and I think we all agree that's an undesirable result. But let's put it into context. Life happens, and we know that, and sometimes these things become a reality. I guess the focus for us is to try to help you understand what the impact will be and how to help you get back on your feet if you found yourself in any of these scenarios. So let's talk a little bit about late payments, and we need to get clear on the definition of that. There's a grace period associated typically with loans, typically 15 days, for example. So there's a grace period that you have. So if I'm due for a payment for an auto loan myself on November the 1st, I'm not going to incur a fee until November the 15th, or excuse me, the 16th. And that's an important distinction, because I talk to a lot of folks who have the mindset that even if it's 1 day late, then you could end up with a problem with the credit bureaus. So I just want to make sure that we're clear. You have a grace period, and that is to protect you from some fees. If you fall outside of that 15-day window, you could arguably end up with some fees, and I think that's a fair statement. Want to really truly get to the definition of what the credit bureau is going to consider a late payment. So that's why you see a 30, 60, 90 detail there on the slideshow. So 30 days late, if your payment is 30 days late, that's when you're going to see an effect to your credit score. Similarly, if you continue to go down that track and continue to miss that payment, that late payment is going to drop into the 60-day bucket, then it's going to drop into the 90-day bucket. And once you start going down that track, it's very difficult to get your score to rebound quickly. Okay? So if you can get back on your feet, and I think all of us have missed a payment somehow, some way, didn't get the bill, got eaten by the dog, whatever, mailman didn't deliver it, whatever the case may be, we've all missed a payment. So here's ultimately what happens. So if I have a 700 credit score today and I miss a payment, I have a 30-day late, right? The score is going to drop about 100 points. As soon as I get right back on track, I'm going to get 70% of that loss back. So the net effect is that I'd lose about 30 points for a late payment. So it's important to understand if you have a late payment and life's going to happen, and we understand that you get back on track to diminish the effect to your credit score. So I want to introduce a concept here called recency. The way that the credit model looks at your payment history is on this basis. So we've got a 4-year window. We've got year 1 that's weighted at 40%, year 2 at 30%, year 3 at 20%, year 4 at 10%. So if I have a late payment, if I have a November 1st payment and I don't pay until December 5th, I'm going to have a 30-day late on my credit bureau. That's going to be a piece of my calculation in the context of how you pay at 35% for 4 years. It's a diminishing effect over time. And the analogy that I like to use, let's say you're driving your car and you're trying to get away from an aggressive driver. The further you get away from that in the rearview mirror, it's a very similar analogy. So this late payment is the negative event, and as you get further away from it in the rearview mirror, your score is going to rebound. So let's talk a little bit about common collections, because this is a piece that really I've seen unnecessarily damage credit scores. Certainly if you have a delinquent loan, you're going to hear from collections. What I would like to highlight is that it's important that you stay connected with your creditor, whether it's us or someone else. In many cases, folks don't want to engage because it's difficult. It's not fun to talk about, but the reality is that if that loan goes delinquent for 120 days, it's going to get charged off, and then some bad things really start to happen. That debt can be sold to a collection agency. They ultimately will engage you, and so you're not going to be able to avoid dealing with the issue. And I guess the good news is, at American Eagle, we're pretty good at coming up with solutions and helping people out. We take a lot of pride in that. Just want to make sure that if for some reason you've fallen on hard times, be connected to your creditor, because it doesn't have to go down the track of a 60-day or a 90-day, 120-day, 180-day late payment. So I just want to make sure that we highlight that. So in the event that one of those late payments drops into a charge-off at 180 days delinquent, some of those common pieces are auto loans, credit cards, things of that nature that could go that direction. More common collections that we see drag down a score unnecessarily are cell phones, medical bills, and a lot of folks go to the ER, think that they've paid their copay, and that's the end of the story. Ultimately, there could be additional charges that you may not be aware of. I've seen that happen more times than I can count with a small medical bill that really has no bearing on your ability to repay a creditor, but it unnecessarily drags down your credit score. So I just want to highlight that. I've seen auto insurance as a collection, and certainly utilities are pretty common in that regard. So the last concept that I want to talk about as it relates to collections is the difference between being active and dormant. So collections can stay on your credit bureau for 7 years. And the longer that they stay on there, the less of an impact they have. Here's the challenge that we've got. If you're unaware that you've got a collection and you realize it after 3 or 4 years, ultimately that doesn't have a whole lot of bearing on your score at that point. So if I see that on my credit report, I'm going to want to pay it. So let's say I pay it. Ultimately, I've taken that collection from being dormant to active. So certainly we want to pay the bills that are on our credit report. Here's my advice to you. Make sure you track your credit report through a website that we're going to show you later in the presentation, so you can understand what's on your bureau. And here's why: because you don't want to end up in a situation where you have to make the decision, do I or don't I pay a bill that I know about? I think that's unenviable for all of us. So you want to make sure that you're tracking that and you're aware of what's on your bureau from a variety of perspectives. So just want to make sure that we highlight that, because collections has some real nuance to it in that regard. And I think that we'd all agree that that's not a scenario that we want to find ourselves in. So that's how you pay at 35%. We're going to shift gears a little bit to capacity, which represents 30% of your credit score. Together, how you pay and capacity account for 65% of your score. So we've got a couple different things here. We've got revolving products are accountable for capacity. We've got credit cards, which is a very common one. Home equity lines of credit is a common one, and unsecured lines of credit is another one. So let's take a look at this example to understand what the impact to the score can be. So if we've got aggregate limits of all the revolving type of products that we have at $10,000, and we've got balances of $4,000, we've utilized 40% of our capacity. We have 60% available. If I have a healthy credit score and I convert that debt over to an installment loan, I'm going to get an increase to my score. A general rule, and this isn't a given because different models look at it differently, but a good general rule is 1 point to the score for every 1 percentage point. So that being said, there are 40 points on the table here if I've got a healthy credit score, converting some of those revolving to an installment. So just want to make sure we highlight that. Conversely, if I've got challenge credit and I've got a 600 score and I have the same 40 points on the board to recapture to improve my score over time, ultimately I'm only going to get about 25% of that benefit, meaning I'd only get a 10-point increase to my credit score. So we're going to talk a little bit more about capacity, but certainly I think we'd all agree that's a pretty easy way, converting revolving debt to installment debt to increase our credit score is a pretty good strategy. How to gain more capacity? There's a couple different ways. I like some better than others. We can raise our current limits. So if you've got a credit card at $10,000, you can apply for more. That would increase your capacity. Understanding you need to have the discipline not to use it. If you just continue to use the card and max out the card or get close to the limit, it's not working for you, it's working against you. You can acquire more revolving capacity, meaning you can get additional cards. There are some implications to that deeper into the discussion as we go through the credit model. I would say that if you have a healthy credit score, 750 or more, that's not really a challenge for you. Where we need to be mindful of that type of situation is kind of in the 600 range, 650 range, things of that nature. But we're going to dig into that here in a couple minutes. The strategy I like best and the best option is to pay down or pay off all of your debt. You can very simply get a installment loan, a debt consolidation loan that you can get here at the credit union and really convert that over and increase your credit score in the short run and set the table for success in the long run. So very simply, the golden rule that we want to highlight: how you pay plus capacity equals 65% of your FICO score. Timely payments and responsible use of your capacity will result in a good FICO score, roughly 700, and we feel very good about conveying that to you. So let's talk about capacity being king. We know that we can pay down or pay off all of our revolving debt to increase capacity and benefit us in terms of credit score. We can raise our revolving limits, and we can acquire more revolving capacity. Again, that can affect the next pieces that we're going to talk about in terms of length in new accounts and inquiries, but certainly a strategy that can be implemented. So let's take a look at a real life example in that regard. So let's say we have a Discover card with a limit of $5,000 and a balance of $4,000, an interest rate of 11%. The capacity available is 20% with a corresponding payment of $160. Going further down the example, Capital One, $2,000 limit with a $1,600 balance, a rate of 21%, capacity of 20, and payments of 64. MBNA, a limit of $4,000, a balance of $3,200, rate of 16%, capacity available 20%, a corresponding payment of $128. Last but certainly not least, American Eagle, a limit of 1,000, a balance of 800, a corresponding rate of 8.9%, which I think we'd all agree is pretty good. Capacity of 20% in a payment of 40. Ultimately, all the payments are based on 4% of the balance that is being carried. I think that's pretty standard to get ahead on your credit card. So let's just assume a 4% payment and a total monthly obligation for all those credit cards of $392. So here's what this could do for you, a consolidation. Save you $94 a month, taking all those credit cards. It could save you over the course of the deal, and that's roughly about 10 years. Credit card debt typically goes about 10 years. Could be more than that in many occurrences. The term savings is $3,145. You would ultimately get a monthly deferral of $392. So that's a global benefit, financial benefit of about $3,500. I think we'd agree that's pretty good. And that's just on the financial piece of it. Then we talk about the impact to your credit score. You can go from a C to an A. That represents roughly 80 points to score. You can go from having decent credit to having very good credit just by simply understanding how the credit model works and how to get ahead from a financial standpoint. So I think that we'd agree that's a pretty good example. And the good news for you is that we have some of the most aggressive personal loan rates around. We actually are running rates right now at 5.99%, where we could very easily consolidate any debt that you might have to give you the benefits that we just illustrated. So if you think that's a good idea, simply call us up. We'd be happy to help you in that regard. So now we're going to get to some of the nuances associated with the credit model. Not quite as significant as how you pay your bills at 35% or capacity at 30%. Let's get into length of credit. So you certainly never want to close your anchor credit card, and here's what that means. Length of credit looks at all the trade lines that you have, and it looks at the ones that you've had for the longest amount of time. Naturally, for auto loans and mortgages, those needs are constantly evolving. We get car loans, we pay them off. We get a mortgage, we refinance it. We sell a house, we get another one. Those are going to be pretty transient in terms of bringing new debt in and out of your credit report. Credit cards typically stay. We all typically have a card that we love the most. So you want to always protect that anchor card or that anchor trade line. If for some reason you close it, for some reason, you guaranteed you will see an impact to your score. So always try to protect that. If you don't have a current credit card, get one and keep that open. And hopefully it's one of our cards. So we want to avoid closing credit cards accounts if we can at all avoid it. Oftentimes closing credit cards is a condition of getting a loan. I would try to avoid that if you can. Sometimes I understand it. Even mortgages sold to the secondary market with Fannie Mae and Freddie Mac have some of those conditions associated with it. But I want to empower you to understand if you were to do that and close your anchor card, you certainly are going to have an effect to your credit score. Conversely, you want to be mindful of adding new cards. Not to say you can't do it. You can do it depending on the health of your score, but you don't want to do too much in a short amount of time. And we're going to get into that piece of it here in just a second. So let's talk about accumulation of debt. That's 10% of your score. It revolves around the addition of new accounts and also the inquiries where you have your credit pulled. There are two types of inquiries. We've got voluntary inquiries, or when we walk into an establishment and we have our credit pulled. If I walk into the credit union tomorrow and I want a personal loan, I'm consenting to have my credit pulled. That's a hard credit pull. It's voluntary. Those credit pulls are documented on your credit report for 24 months. The last 12 months of the activity is what will have an impact on your credit score. Conversely, we've got involuntary credit inquiries. Those are things you don't have control over. Employers can look at your credit bureau, utilities, insurance companies, and when your mailbox or email gets filled up with all types of offers, typically somebody has taken a look at your ability to repay some debt through a soft inquiry, a marketing inquiry on your credit bureau. They don't get the score, but they get to see all the things associated with the trade line activity. So those are things to be mindful of. Certainly, as you're shopping for your lending needs, right, you want to make sure that you protect that. If you have it pulled too many times in a short amount of time, it can have an adverse impact on it. Typically, mortgages and auto loans are treated as a similar inquiry for a certain amount of time. But I will say I've seen credit reports where somebody's gone shopping for a product thinking they're going to get the best deal, and ultimately it's a hindrance to their credit score just because they simply don't understand that that's how the model works. Not to say you don't have your credit pulled. You can, and you should. Ultimately, you just want to manage that and understand you're not looking like a risk in the context of the credit model by having a lot of inquiries, which means you're shopping for money, right? And beyond that, just want to make sure that you understand the impact there. So, going down a level in terms of adding new accounts, I want to be very mindful of adding too many accounts within a 12 or 18-month period. If you're a 750 credit score, really nothing to worry about there. You're well and established, and you got a nice portfolio in terms of your credit score. But if you're new and you just have an established score, want to be very mindful. A lot of folks will rush out to the market after they get a score and get several credit cards, get a car loan. Ultimately, you want to make sure that you manage some of that and protect the score that you've got and be very measured in how you build your credit profile. So last but not least, we've got the mix of credit, that's 10%. In very simple terms, gang, you just want to make sure you have a solid portfolio. You want to have a nice mix of revolving, which is credit cards or lines of credit. You want to have an installment loan or two, maybe a personal loan, an auto loan, and ultimately a mortgage. This is kind of the punctuation mark on the credit model analysis, and it really is just kind of the rounding out factor to make sure that you're well balanced. You're not one-dimensional and have 15 credit cards in one auto loan. You want to make sure that you have a nice, well-rounded credit report. So let's talk about key takeaways. You want to make timely payments. I don't think that's a surprise to anyone. So that correlates back to how you pay your bills, 35%. You want to manage your credit card balances versus their limits. That's capacity, 30%. Convert credit card balances to installment loans. Again, capacity. Don't allow multiple pulls of your credit during auto or mortgage shopping processes. That's tied to inquiries and accumulation. That's worth 10%. Have a well-balanced mix of credit in your report. Mix of credit, 10%. Don't apply for multiple cards to establish credit. That's new accounts. Accumulation, again, 10%. You certainly want to be mindful of accumulating too much debt in a short period of time. That has implications on two fronts. The length, 15%, and accumulation at 10%. Those two pieces go together in many cases. You certainly want to communicate with your creditors if you're having trouble with your monthly obligations. That certainly ties back to how you pay your bills. One thing that I haven't mentioned to this point, but I will mention now, you can consider protecting your loans with credit, life, and disability insurance. Those are insurance products offered really to protect folks that may not have coverage in their household for life insurance, or to supplement current insurance that somebody might already have. So if someone were to have coverage in that regard, God forbid if somebody were to pass away who's on the loan would be paid in full. Similarly, for disability insurance, after 14 days of being out of work, that loan payment would be made until you're able to get back to work for a certain amount of time. So last but not least, I want to talk about never closing your anchor credit card. That's tied to length at 15%. And ultimately, that lands us here at myannualcreditreport.com. Earlier in the call, we talked about being able to take a look at your credit report to make sure there wasn't anything on it that you didn't know about, specifically collections, to manage that dormant versus active issue. And you can get a free version of your credit report here, one from each bureau once a year. So you could pull your credit once every 4 months and be able to track that and understand what the implications are, and understand that you can protect your interests, not just today, but for the long term, and make sure you have the healthiest score possible.